Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Your equity market with a lift on the S&P, positive by 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, President Biden considering a visit to Israel. As the U.S. plans to tighten China's access to chips, investors mulling a week full of corporate earnings. We begin with the big issue, whipsawed by bonds.
A lot of this is whipsawed.
We've been watching these rise in bond yields.
What we're seeing is this enormous volatility.
We're just going into a more volatile world.
We have lost all anchors to the bond market, all of them.
It's not just been the bond volatility of the last 7 days. It's really been the bond volatility of the last 3 months.
The economic anchor, we have lost a technical anchor, and we've lost a policy anchor.
The rise in the long end yields, if anything, was doing the Fed's job.
The Fed is probably done raising interest rates because they realize that the bond market's been recently doing all the heavy lifting.
What level of of rates and financial conditions, do we really need here?
The bond market is looking ahead and figuring out that the Fed indeed is getting it right.
The economy does not weaken, then the path of least resistance for yields is higher.
Joining us now to discuss, JP Morgan's Mira Pandit, Morgan Stanley's Jim Caron. Let's get to you first, Mira. What kind of cue can you take from this crazy bond market action over the last few months?
If it can go wrong, it has gone wrong in the bond market this year. Between some upside growth surprises we saw over the summer to a lack of full supply absorption with all the supply coming in online across the curve. And now, of course, there's a lot of federal finances concerns in the long run, so some real existential threats. I think perhaps the only thing that perhaps has not gone wrong is that we haven't seen a meaningful acceleration in inflation, so that has helped to somewhat keep a lid on the Treasury market. But otherwise, we have just seen instance after instance of headwinds for yields from here. Now, in terms of where we go, yes, we could go a little bit higher from where we are here, but as you start to see growth slow, because we're probably at that high water mark for growth, as you start to see inflation gradually come down, it should cause some relief for yields, but we're not going to see a cratering in yields either. There's really a limit to how much yields can come down over the next 6 to 12 months.
Jim Caron, does it tell you anything about what you should do with stocks?
Well, it's kind of interesting right now because, what it's really saying is that we've had this capitulation in the bond market where one of the most overcrowded trades this year has seen this significant rise in yields. And this repricing has been necessary over the last 6 to 8 weeks. What it tells me about stocks, though, is that finally at these levels, you may actually have a hedge against riskier assets or equities. So bond yields around 10-year yields around 4.7, 4.8%, anywhere close to 5%, to me start to signal that this could be a hedge against riskier assets. Now, look, we've been underweight duration all year, but at this point, I think it's starting to become time to buy bonds, or at least close some of that underweight in duration or close some of that short, because I think that in effect, what you can actually do is de-risk your portfolio by adding high quality fixed income at these yield levels relative to equity. And really what we're looking for is a correlation now to start to break down. Correlations have been very high. Bond returns were negative. Equity returns had come down over the last couple of weeks. Now I think that we're going to see this correlation fall where bonds can actually appreciate in value when equities sell off. And I think that's one of the things that we're starting to look at right now. And it's one of the reasons why I think that this might be an interesting time to start closing that underweight or starting to buy bonds.
Jim, interesting words you're using there. Starting to, closing an underweight. I don't hear get long, get overweight. What's the difference here?
Right. You're picking up on a very good point. We're not advocating getting long. All we're advocating is getting closer to your neutral target of duration. So if you look at index level duration for fixed income, it's somewhere around 6 years of duration. We've been running our duration around 3. We're starting to bring that up towards 4 or even 5 years of duration. So the difference between getting long is that we expect there to be a movement down in yields that's going to generate, strong underlying performance. Really what I'm saying is I think we're in a range. So, and there is risk, as Mira was saying, there is risk that yields could go higher. It is possible. And we're not yet ready to play this. I mean, look at last week's CPI number that came out. Look at some of the bid to cover ratios and bond auctions. This is starting to become a little bit of a weakness story. So we're not ready yet to commit to being long, but we are willing to take some chips off the table from our short this year.
Mira, on that bond call specifically, do you agree?
It's balanced in the bond market. I do agree with Jim that you do still want to position a little bit in short duration because we don't know if yields will go up a little bit further from here. The Fed has still been somewhat unclear about their path for rates for the rest of the year, but we do know it's going to be higher for longer. But when we think about longer duration and adding a bit of duration to portfolios, it has been an area that we've been selectively adding throughout the year. Again, everything has sort of gone wrong for the bond market this year, but nonetheless, we don't see that much more upside for yields. And look, we're probably not going to see a huge fall in yields, as I mentioned before, but even if over the course of the next year you see rates fall by about 1%, which I don't think is entirely unreasonable, you could be looking at a total return of 11 to 12% on aggregate bonds if you add in that income component. So that's not bad for investors who have been experiencing multiple years of a really challenging bond market.
If you aren't familiar with the Fed's position, get ready for the next couple of days. Harker, Williams, Bowman, Barkin, Kashgari, Waller, Williams, Bowman, Barkin, Beigebook, Harker, Cook. Mike McKee, that's just through Wednesday. Then on Thursday, we've got Chairman Powell. Mike, what are we looking for going into the quiet period?
Well, it's going to be a crazy week, both with economic indicators and with Fed speak. And you mentioned Pat Harker. If you like Pat Harker, he's speaking 5 times this week. You should know what he thinks by Friday. Let's look at the economic data first. We had Empire this morning. Interesting number because while the overall number went down, prices paid and prices received went down while employment went up. Who knows what that percentage is for the future. Tuesday, here's something that both Mira and James might be interested in. The tick Treasury flows, they're for August, but they will give us another idea of who's buying and who is not buying at a time when the Treasury needs all the buyers they can get. Jobless claims on Thursday. We'll see if that has any kind of relationship to the UAW strike. But it is the Fed speak that everybody's going to worry about. And I don't have to read off the names because John just did. But there are an awful lot of people speaking, 14 different speakers, 20 different speeches. But the highlight will be Thursday. Jay Powell sitting down with our David Weston at the Economic Club of New York. And they'll be talking about, hopefully, how long is long when you're going to have higher for longer. And I don't think after the week is over, we will really have a clue, but we might get somewhere. Here's an interesting chart, guys, and I throw this up because this is what we're going to want to see the change in by Friday after all this talk, but it really shows you what the issues are for people trying to invest in bonds right now. The blue line at the bottom is where the yield curve was a month ago. The yellow line at the top is where the yield curve was 1 week ago today. And then the white line is where we are today. A lot of movement there. And which way do we go from there? That's the hardest thing to predict, given all this Fed speak out there and all of the geopolitical issues that we face.
That bear steepener has been phenomenal to witness over the previous few weeks. Mike McKee, thank you, sir. Yields lower last week, even with a 20 basis point move higher at one point on a 30-year Treasury off the back of a soft auction. Get your head around that. But that was the bond market action of the past week or so. Mira, let's talk about the Federal Reserve. The Fed seems to be happy to allow the long end of the bond market to do the work for them. Does that put a lid on the front end?
You know, it really depends what the Fed does next, because on the one hand, we've been hearing from a number of speakers more dovish comments about wanting to wrap up the end of the hiking cycle and not necessarily seeing further hikes necessary because we've seen a rise in yields and a tightening in financial conditions. But on the other hand, it was not so long ago, it was just about a month ago, that the majority of FOMC participants saw one more rate hike this year. So I think we can't rule out that we see one last hike this year. I don't think it's necessary given the yield moves that we have seen, but it's still on the table. And if we do see it, I'd rather see it in November so that we can get a little bit of clarity into the end of the year, as opposed to waiting for December, because that will continue to prolong some of the uncertainty in the bond market. And if we can have even just one factor that reduces some of the volatility we're seeing in rates, that would be enormously helpful for investors, even if rates stay elevated.
Short rates. Can we contain the volatility of short rates? Jim, I think this is so important. Let's go through the curve together. 2-year, 10-year, 30-year. 2-year right now feels like it's pinned pinned by policymakers unwilling to step in even if data's stronger and to allow the long end of the bond market to do the work. The 10 years up by 8 basis points again today, 30 years up by 10. Jim, you've got all this flexibility now in the long end of the curve. The Fed's outsourcing policy to long rates. Jim, that's a change. How important is that change to shift the emphasis from short rates, Fed funds, to allowing the long end of the bond market to do the heavy lifting?
I think this is a big change, and we're seeing it right now. Effectively, when we look at financial conditions and when we look at where back-end rates are, whenever I look at, what the forecast of the 10-year note should be, the first place I start is what should the shape of the yield curve be in 6 months' time and in 12 months' time. The curve is still inverted, right? If we look at a 2s to 10s curve, 10-year yields are still below 2-year yields. At some point, those 10-year yields are going to be above those 2-year yields. The curve is going to re-steepen and it's going to get its shape back. The question is, do we have that as rates are going down, or do we have that as rates are going up? I would argue that we have that if rates are going down. And effectively what that means is that if we have a slowing in the economy, if we have a mild recession, I think that people will start to price in these rate cuts, that many are doing. But effectively, the back end of the curve can stay relatively stable around these levels as the front end then starts to come down in yield. Now, essentially, that's not happening right now. Right now, as you were saying, it's all about back end yields moving higher. What that's doing is it's all term premium, it's all risk premium that's being placed into the curve. What that does is it creates a tightening of financial conditions. Where do you get your home mortgage loan? Where do you get your car loan? It's not at the 3-month rate. It's at the 5-year or it's at the 10-year point or even longer than that. So this rise in back-end yields does create a tightening of financial conditions, and I do think it does some of the work for the Fed. But ultimately, we need to see wages, we need to see the economy and inflation start to cool in order for this to really take effect and slow the economy to the Fed's liking. I don't think we're there yet, and that's why I'm a little bit suspicious, even at today's yield levels in the back end, and I think there is risk that they could still go higher.
Just to be clear here, though, Jim, at the front end, and I've heard this a few times over the last few months, and it's been the wrong call, but ultimately, your base case, do you believe that risks are skewed asymmetrically to the downside for lower yields at the front end?
At the front end, I do believe that's correct. I think that it is asymmetrically skewed towards lower front end yields.
Jim Caron, on the bond market, your 2-year right now, not doing much, up by a basis point. At the moment, the 10-year up by 8, the 30-year up by 10. Big moves at the long end again this morning and over the last week. Mirror Pandit, Jim Caron sticking with us. We're about 18 minutes away from the opening bell. Your equity market near session highs up 0.5%. Here's Simone with some movers going into the open. Hey, Simone.
Hey, John, that enthusiasm in the stock market's being reflected by many shares today. One of them is Lululemon. The athletic wear retailer extending gains from post-market Friday when the S&P Dow Jones indices said it would replace Activision Blizzard in the S&P 500. That change is going to be effective October 18th, but we're already seeing shares rally in anticipation of this flow story, up 6.5% in the pre-market. Not so hot, Charles Schwab, reporting earnings this morning ahead of more bank results this week. Charles Schwab saying that net interest revenue sank 24% from the year prior. Clients were moving into higher yielding products. That helped lead to a big drop in third quarter revenues. This obviously important ahead of other major banks as well as regional lenders this week. Finally, Pfizer slashing its revenue and earnings forecasts for the year, but taking a particularly big hit on Moderna shares, those down 3.8% in pre-market trading, leering there, lowering its price target to $64 per share. We're looking at shares higher, though, than 90 for the end of the week. So it's that analyst seeing an extended period of unprofitability that they think is going to push the company towards restructuring here as that COVID demand really dries up.
Hey, Simone, thank you. More from Simone Foxman around the opening bell. Coming up, President Biden pledging support to both Israel and Ukraine.
We're the United States of America, for God's sake. The most powerful nation in the history, not in the world, in the history of the world. The history of the world. We can take care of both of these and still maintain our overall international defense.
Our reporting here at Bloomberg suggesting the president is considering a trip to Israel. Secretary Blinken returning to Tel Aviv. Your team coverage up next.
the United States of America, for God's sake. The most powerful nation in the history, not in the world, in the history of the world. The history of the world. We can take care of both of these and still maintain our overall international defense. We're going to do everything in our power to find those who are still alive and set them free. Everything in our power. And I'm not going to go into the detail of that, but we're working like hell on it.
President Biden pledging assistance to Ukraine and Israel. Secretary Yellen telling Sky News the U.S. can support both wars, saying, quote, America can certainly afford to stand with Israel and support its military needs and also support Ukraine in its struggle against Russia. This coming as President Biden considers a trip to Israel in hopes of preventing the war between Israel and Hamas from engulfing the wider region. Your team coverage begins right now with Ollie Crook from Tel Aviv, AMH in Washington, D.C. Ollie, what's the latest on the ground?
Right. So as we know, Jonathan, what we heard from the Israeli defense units over the weekend is that the next stage of this war will include a ground component. The question is really not a question of if, but now when. And that is a question that we do not know the answer to yet at this stage. The main sort of focus for the military right now has been the aerial assault that has continued unrelentingly for the last week and that through the night and into today. And again, there's the question of aid, getting aid into there on the ground in Gaza, which is a very, very dire situation. But of course, there's also a tension that's splitting to the north, where there have been increased skirmishes with Lebanon. We understand that the Israeli government has now evacuated all of the civilians on the border with Lebanon 2 kilometers out. So this is the other question that we're watching. And of course, the U.S. response has been to send a second aircraft carrier unit into the region to, again, try to step up the deterrence a little bit more.
AMH, we've had a weekend of intense diplomacy and now reports here at Bloomberg that maybe even the president might be making a visit.
Absolutely, Jonathan. It's been frenetic diplomacy throughout the Gulf, and now the president himself is considering and weighing this trip to Israel. On one hand, this will show the U.S.'s forceful support for the Israeli people and their quest, what the Israeli military is talking about, really getting rid of and eradicating Hamas. At the same time, it would be a huge deterrence for the region overall, especially as Oliver is talking about Hezbollah and Lebanon or Iran writ large. This will be a huge deterrence for the region about the U.S.'s presence. It also comes at a time that the U.S. is sending a second carrier strike group to the eastern Mediterranean. We should not overlook the timing of all of this. So potentially the president could go as soon as this week. But, Jonathan, we should note no decision has been made.
MH Jake Sullivan was talking about back channels between the United States and Iran. What came out of that?
Just that there are these back channels. I imagine it's the U.S. wanting to be very direct and frank with Tehran about not getting involved in this conflict. The U.S. really wants to make sure that they can isolate this just to what is going on between Israel and Hamas, not to have this really metastasize throughout the region. Really no surprise there, though, Jonathan, in the sense that the United States, of course, has back channels to Iran. They are just on the heels of doing a hostage swap deal that unfroze that $6 billion in aid that has become one of these touchstones for the Biden administration, that money that's sitting in the Qatari banks. They could do this through Qataris. They could do this through Omanis. They could do this through the Swiss. There's a number of ways they can have these back channels, and I imagine they are being very frank with Iran at this moment.
MH, our chief Washington correspondent down in D.C. Ollie on the ground in Israel. Ollie, stay safe. It's good to catch up, buddy, as always. Here's the latest right now. How do you process two opposing ideas? And Mira, I'll save you from this conversation for obvious reasons. When a bank CEO says this may be the most dangerous time the world has seen in decades, and then Jim Karen, the same bank CEO, reports a record quarter of net interest income, boosts the forecast for the year, and reserves for loan losses come in better than expected. Jim, how do I process two opposing ideas?
Well, look, I mean, it's very, very challenging right now. You know, in one sense, we have to look at economic valuations. We're coming off of a very, very strong third quarter. I think the economy is slowing. I don't think it's collapsing. So in many ways, when we look at the economic cycle, the economic cycle is marching to the beat of its own drum. Geopolitical events, you know, really create just a really large uncertainty factor. Until that really manifests itself, until we know what the conclusion of all of this is, or potentially what the fallout may be, it's not going to have an impact to earnings. So the earnings in many ways are backward looking, and they're looking at what had happened. On a go forward basis, do we want to continue to hold risky assets? Do we want to continue to hold equity into this? I think unfortunately what happens is that markets get frozen. We're already worried about a recession that potentially may happen next year. Now there are all these geopolitical events that are taking place, and we don't know what the fallout or how that's going to end up. So I think on a go-forward basis, what we can take away is that the run rate of the economy is okay. It's slowing, it's cooling, but it's not collapsing. It's okay. So I still want to own these cash flows. I still want to own these assets unless we learn something has fundamentally changed. So it's hard to square it and tie it up into a neat little bow. But that's the way that we're looking at it, is we want to really just create a durable portfolio where hopefully we have more upside capture the downside, but we do want to hedge the downside risk too, and high quality bonds can do that.
Chairman Powell talked about the struggle of navigating stars under cloudy skies. Mira, just how clouded is visibility going into 2024?
It's quite cloudy. And look, I think about it in this way. It's here today, gone tomorrow. When we think about economic growth, things can go from ripe to rotten pretty quickly. And there have been so many opposing views on the economy. Look, I travel quite a bit. I've never not landed when it comes to a plane, so I don't put a lot of credence behind a no landing scenario. I think we're probably circling the airport a little bit. It's a delayed landing. And while things look good today, none of the risks have been taken off the table. Many people are taking down their recession probabilities for next year, but we still have high rates. We still have a slowdown in lending that's going to take place over the next year. There are still headwinds to the consumer. So if you can't take those risks off the table, I don't think you can take recession off the table either. The good news is when you're talking about recession for 18 months, corporate America does have the opportunity to plan a little bit more robustly in terms of the resiliency of their revenues and making difficult decisions around expenses. So that has been an advantage. But corporate CEOs are also not sure whether we're going to have an ice storm, a sandstorm, a hurricane, or a heat wave. So that becomes hard to plan for, too.
British Airways into London Heathrow, round and round in circles. Anyone who's lived that nightmare every single morning trying to land there. Mira, thank you. Mira Pandit, Jim Carrington, to both of you. Thanks for the update. Equities right now, session highs up by 0.6% on the S&P. Coming up the morning calls and later. Big bank earnings giving way to big tech results later this week. That conversation still ahead with DWS Groups. David Bianco, Jason Goldberg at Barclays on the banks. All of that coming up soon. Equities higher. Let's get you some morning calls. First up, Stifel upgrading Colgate to buy, 117 price target, pointing to improving margins and strengthening fundamentals. UBS upgrading United Health, expecting shares to rally after the company's impressive Q3 results. And finally, Goldman downgrading KB Home, seeing limited upside in the current operating environment. Coming up, earnings season ramping up with big tech results just a few days away. That conversation up next with David Bianco of DWS. Your opening bell just around the corner. 25 seconds away from the opening bell this morning. Good morning to you. State of play looks like this on the S&P, up by 0.6%. On the Nasdaq, up by 0.3%. 2 weeks of gains on the S&P 500, helped out last week by the bond market. Yields lower following 5 weeks of yields moving the other direction. There's your opening bell. Switch to the board and get to the bond market. Yields look like this now. They're moving higher again by 9 basis points. 470.60 on a 30-year, up by more than 10 through much of the last few hours. In the FX market, the euro clinging to some strength. Bit of dollar weakness, euro dollar 105.37. That currency pair positive by 0.25% and crude lower by 0.6% to $87 and about 20 cents. About 20 seconds into this session, we look like this on the S&P. We're positive by 0.4%. We're up by a third on the Nasdaq. One stock to watch at the open, Pfizer, slashing its revenue forecast after agreeing to take Paxlovid doses back from the government following weakening demand. Jefferies upgrading shares to buy, writing this. Paxlovid cuts largely drove the downward revision. We see an attractive catalyst path ahead. Simone Foxman has more. Hey, Simone.
Hey, John. Yeah, shares here up more than 1.5% despite this dramatic cut to its guidance for the full year. Earnings per share had been something like $3.25 to $3.45. The company now seeing $1.45 to $1.65 a share for the full year. Revenue expectations had been $67 to $70 billion, now just $58 to $61 billion. Wall Street estimates had been on the low end of guidance, but not quite this low. And we did see losses in the pre-market, but clearly we have gone back to some gains here in the early market trading. CEO on a call this morning talking about how just 17% of Americans will get a COVID booster, and a lot of this weighing on demand for Paxlovid. But there were some positives here. The company agreeing to take back 7.9 million courses of Paxlovid from the government. This clears out some of the inventory that's been in the market. So it'll allow Pfizer to sell these doses at likely about $150 more than they were selling them to the government. Pfizer also announcing a cost-cutting plan. Wells Fargo joining in with Jefferies there, saying that this is a reset. This is a good first step towards the recovery. The magnitude of weaker demand is likely surprising for investors, but clearly they're not daunted this morning. Shares up 2.4% after declines of some 36% this year, John.
32.93. Simone, thank you. Simone Foxman on top of the Pfizer story. Let's turn to sports. Manchester United falling after news that the Qatari group was stepping back from a potential takeover. Guy Johnson has this one. Morning, Guy.
Morning. So it looks like Jim Ratcliffe's Ineos's Jim Ratcliffe is going to buy a 25% stake, John. But what's interesting, he's going to pay around $1.3 billion for that, which means effectively he is paying a greater premium. 25%, does that remove some of the challenges that Manchester United face right now? 10th in the league, bottom in the Champions League. Is this going to be the big step change for this club? It's interesting, at the moment we're all watching what is happening or happened with David Beckham, and it kind of just reminds us of the glory days of Manchester United. Is Jim Ratcliffe and that $1.3 billion going to be enough to end the Glazer era? Probably not. Is it going to be enough to compete against some of the super rich clubs we now have in the Premiership? Probably not. Does this take this club forward significantly? Well, I guess you can probably suspect the answer to that question as well, John.
I've enjoyed that Netflix series, Guy. I enjoyed that a lot. Guy Johnson, thank you. Out of London. Look out for Guy's coverage there with Alex Steele on that name. Manchester United now down by about 8.8% in early trading, 18.24. Let's turn to chips. Semiconductor stocks underperforming after Bloomberg reported the US plans to tighten China's access to advanced chip technology. Ed Ludlow on top of this. Morning, Ed.
Yeah, good morning, Jonathan. According to Bloomberg sources, the intention here is to reverse the loopholes and deficiencies that were in place, frankly, when these curbs were first enacted a year ago in October of 2022. In terms of what the specific actions are, Bloomberg sources tell us that we are looking at graphics cards or GPUs in AI, but also the chip-making equipment at an advanced level that goes into that. What the US is going to do is, A, impose additional checks on Chinese companies which are basically routing shipments through other nations in order to circumvent or evade export restrictions. They're also going to relook at the restriction list and go for some of the Chinese chip design firms. In other words, if you want to do business with one of the Chinese chip design firms and they are on that list, you're going to need a US license or waiver in order to fulfill orders with that company. Sources saying that these updated restrictions could be published as early as this week. It's interesting to note the response to this Bloomberg reporting. Spokespeople for the National Security Council declined to comment. A spokesperson for the Commerce Department's Bureau of Industry and Security declined to comment, but a Chinese Foreign Ministry spokeswoman, Mao Ning, said, quote, that the US is politicizing, instrumentalizing and weaponizing trade and tech issues, and for that reason they'll continue to monitor it. This is the equity reaction. It was more pronounced in the pre-market. You actually see a number of those names now higher. The expectation that tighter curbs would come, but note that overnight in both the Asian and European session, both chip equipment makers and other names that hope to do business with China or have exposures to China on the top line did see downward movements, John.
Ed, thank you, mate. Appreciate it. Ed Ludlow, Caroline Hyde, noon Eastern on Bloomberg Technology. I have no doubt they'll be talking about this next story. I want to stick with China. Sales of Apple's new iPhone 15 worse in China than its predecessor over their first 17 days after release, according to a study. Mandeep Singh on top of this one. Mandeep, what's happening?
Well, so clearly, expectation was that there will be pent-up demand in China for the new iPhones, and it looks like from the data that we have seen so far, that doesn't seem to be the case. And look, with Apple, they've been taking share in smartphones over the years, albeit, it was 1% to 2%. In this case, it doesn't feel like a pretty big upgrade, and that could be part of the reason why this is the case, but it's too early to say that, they've got issues where people will just not upgrade their iPhones at all. It's not as if they're losing market share here.
Mandeep, for China specifically, do you get the feeling this is just weak consumer spending trends, or is this competition?
Well, I think it's too early to say it's competition, simply because with Apple, it's about the ecosystem. And, I think what they're missing here is a new device category. People are just keeping their iPhones a lot longer. And they didn't provide enough features, barring, a new camera, for people to go out, the existing iPhone users to go out and upgrade their phones.
Mandeep, thank you, sir, for the latest on this. That stock is down by about 0.5%. Two reports here. One from Counterpoint Research, who said sales of Apple's flagship device are down about 4.5% compared with the iPhone 14 over the first 17 days following release. Another report from Jefferies, the analyst there led by Edison Lee, reckons sales of the iPhone 15 were down by an even sharper double-digit percentage from its predecessor after Huawei outsold Apple overall. Again, need to work out one, to Mandeep's point, if it's too early, but ultimately if this is the story. Two, is it consumer trends? Or three, is it competition? We'll get to that, no doubt, through the next couple of months. That stock just a little bit lower, softer, lighter, negative by a third of 1%. Earnings season started to pick up momentum. Big tech stocks like Netflix and Tesla joining the banks in reporting results this week. Citigroup's index of earnings revisions revealing downgrades have outpaced upgrades for 4 consecutive weeks. Morgan Stanley's Mike Wilson weighing in right in this. We should see an upward inflection in earnings revisions breadth into year end from here. If revisions underperform over the coming weeks, it would be a sign that other risks, including macro headwinds, are driving the earnings revisions backdrop. I want to continue this conversation now with David Bianco of DWS. David, to you, sir, on the earnings, what are you looking for from big tech later this week?
Good morning, Jonathan. Well, we're going to be looking for big tech to produce good results, probably not great. And we're going to be counting on big cap tech and communications to do the heavy lifting for earnings next year. But my expectation, as we're in this first proper week of earnings season, we'll keep an eye on more of the companies to report while keeping another eye on the bond market. But I do think that even though earnings are going to be decent this year, and there'll be a little bit, maybe 1% growth versus this time last year and also this time 2 years ago, I don't expect there to be strong earnings results that boost this market to higher levels, particularly not with the geopolitical backdrop and the climb in long-term yields. By the way, I do think as earnings season goes on and the year goes on, the estimates for next year will be cut significantly.
David, that's the earnings. You mentioned the bond market. Is the bond market still in the driving seat for equities from your perspective? And should this equity market take comfort from last week's drop in yields?
Yeah, the bond market's still in the driver's seat because the PE multiple is where there's a lot of uncertainty and volatility. We're all keeping an eye on not just the pace of the climb in the 10-year yield, but does it flirt with 5%? Does it go over 5%? If the 10-year yield goes over 5%, I think it's going to spoil any kind of year-end rally for the equity market, probably compress the PE on forward earnings by closer to 18. So to me, the Fed needs to say the job's not done. They might need to put a hike through November 1st, or at least continue to threaten to do so, because the bond market's concerned about the deficit. And if the Fed doesn't stay hawkish, I think the long-term bond market could continue to flirt with 5% on the 10-year yield.
Interesting. David, I think this is really important. We always start with this question: is the bond market in the driving seat for equities? Then we get to the next piece of it: should we take comfort in the drop in yields? David, what's often lost, and I think is equally as important, if not more important, it's what's driving bonds. What is behind the point that we saw last week, yields aggressively lower, then before that over the previous 5 weeks, yields aggressively higher? What do you think is the dominant driver of things? And does that matter to whether you should take comfort from it or not for equities?
There's multiple drivers, but probably the newest and most significant driver of late is the deficit and the dysfunction in Washington, D.C. And then there's the still ongoing battle with inflation. While it's coming down a bit too slowly, particularly from the perspective of a long-term bond investor. The inflation break-even is about 2.3, around there. So the long-term bond market still believes the Fed's going to get the job done and get inflation back to 2%, 2.0 eventually. But the question is, how high do they need to hike rates in order to get inflation down and prevent any risk of a reacceleration of inflation? If inflation reaccelerates while this deficit continues to be a major problem, yeah, that's how you can end up getting an over 5% 10-year yield real quickly. So the Fed, I think, needs to go into the next meeting thinking what action of theirs, what language of theirs most prevents or mitigates the risk of a 10-year yield jumping over 5%. Well, long-term yields are doing some of the work for the Fed right now. I think if 10-year yields go over 5%, it'll do too much work and raise the risk of a hard landing. The Fed certainly doesn't want that either.
David, with that in mind, you're underweight tech, you're underweight autos. Is that a bond market call?
No, it's actually more of the valuations are just a little too demanding. Yet there are parts of tech that are still cyclical. There are particularly tech hardware, even semiconductors. They're not all artificial intelligence plays right now. So we do think the valuations are demanding with or without the risk of higher interest rates. And while we do expect strong earnings growth out of tech next year, it's going to need to be well into the upper teens, and that will need to be the outlook for the next few years to justify these valuations. That's a demanding outlook given the world economy, currency, the dollar's strong. We do think that tech software and some other companies can do it, but it's a lot of growth to ask for this sector, albeit it is the biggest sector of the S&P.
David, just finally, what are you advocating for in the financial sector?
Well, in the financial sector, we like the biggest of banks. We already heard from that one. But that's not an indication of what's going on at all of the banks. We're still cautious on small banks, capital markets. But the big money center banks, we find those valuations attractive enough. And we like insurance companies, given this new yield to be found in longer-term fixed income. That benefits the insurance business model.
David, good to catch up, buddy. As always, David Bianco there of DWS. Coming up, more big bank earnings on tap.
For all of the fears out there, John, around this bank so-called crisis, the earnings so far that we've seen have been quite good. So we feel pretty good so far to start these earnings season.
With equities up by 0.6% on the S&P about 13 minutes into the session, that conversation on the financials with Jason Goldberg of Barclays up next.
The fears out there, John, around this bank so-called crisis, the earnings so far that we've seen have been quite good. What it shows, John, more than anything, is just the resiliency of these business models. And despite all the machinations of rates and credit and capital, the earnings stream and the revenue streams of these banks is actually quite annuity-like or utility-like in nature. So we feel pretty good so far to start these earnings season.
Big bank earnings resuming this week. Bank of America, Goldman reporting Tuesday, followed by Morgan Stanley on Wednesday. Today, investors digesting numbers from Charles Schwab, reporting a 24% decline in net interest revenue as clients move cash into high-yielding products. Bloomberg's Sri Natarajan joins us now for more. Sri, what's the latest?
Well, you're right about Schwab, John. Everyone's focused on their results. They've, of course, been a big problem child this year, with the stock down about 40% coming into earnings today, which would make it their worst year in more than 20 years. There has been a bit of a bounce in the results. Deposits are down, but not as bad as investors expected. And that is perhaps leading to some more hope, especially in September. The trend has been decelerating, and investors will hope that stands true. But really, we're heading into tomorrow and Wednesday when the remaining three big banks will report. That's Bank of America, Morgan Stanley, and Goldman Sachs. Those three also happen to be the three worst performing big bank stocks. Slightly different dynamics. With Bank of America, you'd be looking at what are they saying about the economy? What are they saying about loan losses? Because that's what we heard from JP Morgan and Wells Fargo. Despite improving their NII outlook, JP, Wells, and even Citigroup talked about loan losses increasing on the forward. With Goldman Sachs and Morgan Stanley, however, all the commentary and all the focus will be where are they seeing the rebound in investment banking activity? Will 2024 look way better than where it is right now? Because when they report their third quarter results, investment banking results will still be depressed. And perhaps that's a reason for why the stocks, both at Goldman Sachs and Morgan Stanley, are down about 9 and 10% this year.
Things a little quieter for Mr. Solomon over at Goldman as well. Sri, great reporting as always. Sri Natarajan there of Bloomberg on the latest. Barclays weighing in on the challenging environment facing the banks, writing this. The Fed has signalled interest rates next year could be even higher. The UAW went on strike, the government shutdown was delayed and oil prices have increased. While we don't expect these factors to impact near-term results, they could weigh looking out. Jason Goldberg at Barclays, I'm pleased to say, joins us right now. Jason, overweight B of A, overweight Goldman, overweight Morgan Stanley. What's the read across from the numbers, Jason, that we got on Friday for the names that fall under your coverage over the next 48 hours?
Yeah, no, I think we did learn a lot on Friday. I mean, what you saw from, JP Morgan and Wells Fargo was both net interest income and loan loss provisions were actually better than expected, allowing both companies to exceed consensus forecasts. And then if you look at the capital markets related revenues, both Citigroup and, JP Morgan posted higher FICC revenues from a year ago. And while equities was down, it was down relative for tough comps. And both Citi and JP Morgan actually post increases in investment banking fees from the prior quarter, although, that was fairly a subdued quarter. But you did see a bounce back in advisory revenues, kind of overshadowing continued weakness in equity underwriting, although both kind of indicated September was an approved month, which could bode well, for the back half of this, the latter part of this year into next.
Jason, just to build on what we could see in the next few months and maybe even into next year, you said it coming into the release for these earnings from these big banks on Wall Street. Loan growth was subdued. Deposit costs have been increasing. Jason, any reason to believe that those issues ease in the coming quarters?
Probably not. But keep in mind, the pace of deposit cost increases, at least from the 4 banks we saw report last week, was, smaller than the increase we saw in the prior quarter. And typically deposit costs tend to peak, a quarter or two after the Fed stops hiking. And so we'll feel like we're, I'm not sure if we're at the end of this Fed tightening cycle, but we're certainly kind of near the tail end of it. So we would look for deposit costs, to peak next year. And listen, loan growth is going to be somewhat reflective of the economy. It was certainly subdued, so far this quarter, outside of credit card, and likely to remain a little bit pressured, until we get kind of further clarity if the Fed can actually engineer a soft landing.
Bank of America year to date, these numbers already, down almost 20%. JP Morgan year to date, up 10%. That is massive relative outperformance for JP Morgan. Jason, what explains that?
Yeah, I think, for JP Morgan, a lot of the upside, I think they're a big beneficiary of the acquisition of First Republic, which is certainly additive, to earnings this year. So I think that helped them. With Bank of America, there has been some concerns around unrealized losses related to their securities portfolio. And while we certainly don't think that's going to actually, weigh looking out, it is something that has bothered investors, particularly, given issues some smaller banks ran into earlier this year.
Jason, what gets them out of the penalty box? Is it just a bond market rally? I asked this question last week. What else can they do?
Yeah, I think time. I mean, listen, to date, every single security in their portfolio essentially has matured at par, and those, unrealized losses go away. And looking out, we expect that trend to continue. It may take some time. But whether it's a function of securities pulling to par or, ultimately rates going lower, those unrealized losses, will go away. And mind you, right, each quarter they generate cash flow off their securities portfolio that they get to reinvest at much higher rates, which should help benefit net interest income. And in fact, despite some headwinds, we still expect net interest income to grow in the high single-digit area this year.
Jason, good to catch up with you. As always, busy week ahead, I know, for you and the team. Jason Goldberg there on the latest in the financials over at Barclays. The broader market at the moment up by 0.6 on the S&P, up by 0.5 on the Nasdaq. Let's get you some sector price action. Here's Simone.
Hey, John. Yeah, every sector higher so far in early trading, led by the consumer's discretionary, real estate and utilities, leading the end negative here or actually positive here for the day, but lagging behind so far. I'm particularly focused on the communication services sector. Bank of America talking about how we've seen a larger share beat on earnings. We'll start to hear some of these consumers communication services names coming in with Netflix, AT&T. These are the laggards records so far this month, but we don't expect to get Electronic Arts, Alphabet, Meta, some of the bigger names until later this month, early next month. Year to date, though, we're on pace for the biggest surge since 1998. This index up 44%.
Simone, thank you. If you don't like Fed speak, here's the bad news. Pretty much every single Fed speaker is speaking this week. Here's the good news. The quiet period is just around the corner. Your trading diary is up next. Equities up. Here's your trading diary. Secretary Blinken meeting with Israeli officials Tuesday. B of A, Goldman earnings. Wednesday, Morgan Stanley, Netflix and Tesla. Thursday, another round of claims plus. Fed Chair Jay Powell headlining a week full of Fed officials ahead of the quiet period. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.